Your money-making broadcast starts now. Good evening, Canada. Today is May 28th, Thursday. Here are the top stories moving the markets. We are seeing a fascinating tug-of-war between geopolitical tensions in the Middle East driving oil prices higher, and a resilient U.S. tech sector grappling with mixed earnings. From the TSX steady performance to the dramatic volatility in Salesforce, we break down what this means for your Canadian portfolio tonight. Let's begin with today's market numbers from a Canadian perspective. The S&P 500 closed virtually flat at 7,520.36, while the Nasdaq inched up 0.07% to 26,674.73. The standout performer was the Dow Jones, which rose 0.36% to 50,644.28. Closer to home, the TSX energy sector is feeling the impact of surging oil prices, with Brent crude jumping 2.11% to $94.20 as U.S.-Iran tensions re-escalated overnight. This is particularly relevant for Canadian energy producers like Suncor and Canadian Natural Resources, which typically benefit from higher oil prices. The VIX dropped 4.23% to 16.29, telling us that institutional investors are not panicking about the geopolitical situation, they see it as manageable. On the currency front, the Canadian dollar typically benefits from higher oil prices, though broader risk-off sentiment could provide some headwinds. Gold slipped 1.33% to $408.49 as safe haven demand eased. Looking at small caps, the Russell 2000 held at $290.37 with an RSI of 54, suggesting plenty of upside for Canadian and U.S. small-cap investors. Our portfolio maintains a 76.2% cash allocation, providing significant dry powder for opportunities that may arise from market dislocations. Let's dive into our first big story, the energy paradox and the TSX. Today, we saw Brent crude climb to $94.20, a jump of 2.11%, following reports that Iran targeted a U.S. airbase after fresh American strikes. For Canadian investors, oil is the heartbeat of the TSX. Usually, a spike in crude provides a massive tailwind for our energy giants. However, the market reaction today was surprisingly muted. JAVIS analysis shows that while oil rose, the VIX actually dropped by 4.23% to 16.29. This is a critical signal. It tells us that institutional investors have already priced in a certain level of Middle East instability. The fear isn't spiking, it's being absorbed. For the TSX, this means we aren't seeing a panic-driven rally in energy, but rather a steady, fundamental support. We are monitoring the $96 mark for Brent crude. If we break that, we expect a more aggressive move in Canadian energy equities, but for now, the market is treating this as a manageable risk. The key takeaway for Canadians is that the correlation between geopolitical shocks and immediate TSX gains is weakening as the market becomes more sophisticated in its risk absorption. Moving to our second big story, the Salesforce roller coaster and the AI monetization gap. All eyes were on CRM today. The numbers were, on paper, a massive success. Revenue hit $11.13 billion, a 13.6% beat, and EPS came in at $3.88, a staggering 65.1% beat. Yet, the stock closed at $177.51, essentially flat compared to the previous day. Why? Because the market doesn't trade on yesterday's wins, it trades on tomorrow's growth. Salesforce provided a soft guide for the second quarter and raised concerns about the monetization speed of their AI agent force. JAVIS notes a partial success in our predictive model. We correctly forecasted the beat, but the market's reaction to the guidance was more pessimistic than expected. However, the recovery from an after-hours low of $174.73 to a high of $183.92 during the day shows that dip buyers are still active. With Citi maintaining a $225 price target, there is still a 26.7% upside. The lesson here for the AI trade is clear: the AI hype phase is over. We have entered the show me the money phase. Investors are no longer satisfied with just having AI features, they want to see those features driving quarterly revenue growth. This is a warning for all tech holdings in your portfolio. Growth at any cost is no longer the mantra. Sustainable, monetized growth is the new gold standard. From a Canadian investment perspective, several factors deserve attention. The Bank of Canada's policy trajectory remains closely tied to both domestic inflation data and the Fed's moves. If Friday's PCE comes in hot, it could delay rate cuts on both sides of the border, which would have implications for Canadian bond yields and the housing-sensitive sectors of the TSX. On the energy front, the Iran situation adds a layer of complexity. While higher oil prices benefit Canadian producers like Suncor and Canadian Natural Resources, the broader risk-off sentiment that typically accompanies geopolitical crises could offset some of those gains. The CAD typically trades with a positive correlation to oil prices, so we could see some loony strength if Brent pushes toward $100. However, if the Iran situation escalates further, the initial oil-driven CAD rally could reverse as risk appetite evaporates globally. Looking at our portfolio from a Canadian dollar perspective, our holdings include FFH.TO at $2,171 and CP.T at $126.24, both providing defensive exposure to Canadian markets. BB.TO at $11.99 has been a standout performer with a 10.1% gain. The TSX listed positions provide natural currency hedging against US dollar to Canadian dollar fluctuations. With our cash position at 76.2%, we are well positioned whether the next major move is a correction or a continuation. The stop losses remain our key risk management tool, CP.TO at $100, FFH.TO at $2,000, and BB.TO at 10 Canadian dollars. None of these are currently under pressure. Our third big story focuses on macro trends and the Bank of Canada's shadow. While the US markets were flat, the Dow was the strongest performer, up 0.36%, signaling a rotation into value. For Canadians, this shift is mirrored in our preference for dividends and stability. We are currently seeing the Nasdaq hit an RSI of 70, which is deep in overbought territory. This suggests a high probability of a correction in growth stocks. Meanwhile, the Canadian dollar is navigating a complex environment where high oil prices support the CAD, but the potential for the Bank of Canada to diverge from the Fed creates volatility. JAVIS is closely watching the PCE data coming out this Friday, May 29. This is the big one for the Fed and, by extension, the BOC. If inflation remains sticky, we could see a hawkish tone from Fed officials like Kashkari and Goolsbee, which would put pressure on the TSX interest rate-sensitive sectors, particularly real estate and utilities. Currently, the market is in a 34-day bull run. History tells us that these runs rarely go uninterrupted. With the S&P 500 at 7,520.36, and the Nasdaq at 26,674.73, we are near 52-week highs. The strategic move right now is defensive. JAVIS has increased cash reserves to 76.2% of the total portfolio, which is a maximum defensive posture. We are waiting for a meaningful pullback to deploy capital into high-quality assets, rather than chasing the peak of an overextended rally. Looking ahead to Friday, the US PCE price index will be the marquee event for markets on both sides of the border. A strong PCE reading would reinforce the hawkish Fed narrative and could trigger a risk-off move that impacts Canadian markets as well. However, Canadian investors have some natural advantages in this environment. The TSX energy weighting provides a direct hedge against the oil price surge we're seeing from Iran tensions. The gold mining sector could also see renewed interest if geopolitical tensions escalate further, despite gold's pullback today. From a portfolio construction standpoint, our 76.2% cash allocation provides the flexibility to navigate this uncertainty. The key stop losses for our Canadian holdings are all intact: FFH.TO at $2,000, CP.TO at $100, and BB.TO at 10 Canadian dollars. Our US holdings also have clear stop loss levels: CRM at $165, AMD at $440, CCL at $24, Cisco at $108, Broadcom at $390, and SoFi at $14.81. The maximum portfolio loss scenario, even if all stop losses are triggered simultaneously, is approximately $1,168, or 1.12% of total portfolio value, a level that Druckenmiller's capital preservation framework would deem perfectly acceptable. Wrapping up today's session for our Canadian audience, the key takeaway is that the market's resilience in the face of both Salesforce's soft guidance and the Iran escalation is a positive signal for the bull case. The VIX at 16.29 confirms that fear is receding, not building. Our portfolio maintains strong defensive positioning with 76.2% cash, and all stop losses are intact. Whether you're a Canadian investor focused on TSX energy plays or a global investor watching the AI semiconductor story, the common thread is discipline. Know your stops, manage your position sizes, and let the data guide your decisions. Remember that the best investment strategies are boring ones: diversify, set stop losses, and stick to your plan. Today's session proved that discipline wins. That's the lesson from today's market action, and the one we carry into Friday's PCE release. Canadian investors should stay the course. That's today's market briefing from JAVIS. Stay disciplined, Canada. See you tomorrow. Let's stay smart. To recap, we've seen the market absorb the Iran-US tensions with a lower VIX, while the AI sector is demanding real revenue over promises. We are maintaining a high cash position to protect against a potential Nasdaq correction as we head into the PCE data release. Now, let's look at the JAVIS recommended lineup for your portfolio. For a safe type investment, the legendary father of modern value investing, Benjamin Graham, would choose Cisco Systems, CSCO, at $119.67. This is a star position with a 25.1% gain. The rationale is based on a strong moat in AI networking and a reasonable valuation that provides a significant safety margin. We believe in holding this core position as it provides stability in a volatile market. For a balanced type play, the legendary fund manager Peter Lynch would choose Carnival Corp, CCL, at $27.98. Despite the oil price spike, CCL surged for 0.75% today. This indicates that cruise demand is currently stronger than the headwind of fuel costs. It offers a blend of recovery growth and value, with a current P/L of nearly 10%. For a growth-type opportunity, the world's leading innovation fund manager Cathay would choose Micron Technology, MU, at $928.41. With a 3.63% jump today and a massive 26.8% gain over 5 days, MU is riding the AI memory explosion. UBS has a target of $1,625, and the momentum in high-bandwidth memory is too strong to ignore. Finally, for a low-cost type entry, the legend of growth stock discovery Phil Fisher would choose BlackBerry, BB.TO, at $11.99. This Canadian play is approaching a critical resistance level of $12. With a 10.1% gain, it represents a low-cost entry into the cybersecurity and IoT space, offering high asymmetric upside if the $12 level is broken convincingly. Subscribe for daily Canadian market insights. We break down the data so you don't have to. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.